Welcome to The Explainer. Today, we're diving into the insurance crisis that so many people are facing. It's supposed to be the safety net for your absolute worst day, but for way too many people, that net is just gone.
And let's just start with this quote because it really says it all. Spencer Donnelly, a homeowner in California, says he's getting crushed. His insurance is up 166% in just 4 years. And he's not alone. Millions of people are caught in this crazy spiral of insane costs and vanishing coverage.
So this brings us to the central question, right? The one that makes you feel like you're going crazy. How on earth can your bill shoot through the roof or your policy get dropped entirely while that same exact company is posting record multi-billion-dollar profits? It just doesn't add up.
Well, it turns out this might not be random at all. There are some really serious allegations that this is all part of a specific strategy, a playbook. Some have even called it a system of institutionalized fraud. So, okay, let's get into it. It all seems to trace back to the 1990s. This is when a huge shift allegedly happened that turned the entire point of insurance completely on its head. The goal was no longer just about managing risk. It was about re-engineering the whole system to turn your claims into their profit center. They call it the McKinsey method. According to sworn testimony from people on the inside, the consulting firm McKinsey basically advised insurance companies to change their entire philosophy. It wasn't about fulfilling a promise anymore. It was about winning what one expert called a zero-sum economic game against their own customers. And the playbook is shockingly simple. It's a 3-step process: delay, deny, and defend. First, you delay. You just drag out the process for so long that people get exhausted and give up. Then you deny. Whistleblowers have testified they were told to literally alter damage reports and use any tiny technicality to say no. And if someone actually pushes back, you defend. You use your army of lawyers to crush them in court. And this quote, wow, it comes from a McKinsey presentation to Allstate. Their good hands are boxing gloves. It perfectly captures that alleged shift. That friendly slogan we all know was apparently reframed internally as a weapon. The relationship was no longer about trust. It was about combat. So how does a strategy like that translate into the insane numbers we're seeing? Let's follow the money, because this is where the story gets really confusing and honestly, for a lot of people, pretty infuriating. Okay, look at this. This is the disconnect. A company like Allstate can post a staggering $4.6 billion in overall profit. But then they point to one market, like California, and claim they lost $4.1 billion there. So they use that regional loss to justify pulling out, canceling policies, and demanding massive rate hikes, all while the parent company is absolutely rolling in money. And get this, while all those policyholders are seeing their rates go through the roof, the CEO of Allstate, Tom Wilson, took home $26 million in 2023. This is the kind of stuff that just drives people nuts, and you can see why. So you might be wondering, how is this even possible? Well, here's the crucial thing to understand. Insurance isn't just about premiums. It's a massive investment machine. They take all that cash you pay them every single month and they invest it to make huge returns. In fact, they can pay out more in claims than they collect in premiums and still be incredibly profitable because of their investments. And if you want to understand the scale we're talking about, just think back to 2008. The US government had to bail out AIG, the world's biggest insurer, to the tune of $182 billion. And that wasn't to cover claims from a hurricane, it was to stop their bad financial bets from taking down the entire global economy. It proved, without a doubt, that these companies are considered too big to fail. So let's bring this back down to the ground. How do these huge corporate strategies and financial games actually affect real people? We're going to use California as a case study because right now, the whole system there is just buckling. So as all these big private insurers pull out, hundreds of thousands of homeowners are being forced onto something called the theyre plan. It's basically a state-mandated last resort option. It's expensive, and the coverage is minimal. And just look at that growth. It has nearly tripled in just 5 years. The state is now on the hook for a mind-boggling $393 billion in potential risk. And this is the kind of impossible choice people are facing. The owner of a historic hotel, Charity Jackson, saw her premium jump from about $11,000 a year to over $62,000. It's just impossible. So she had to make a devastating decision to go without fire insurance. She is now, as she puts it, completely not covered for any kind of fire. And remember that delay tactic from the playbook? Well, this is the human cost. Mr. Patel's family was left in limbo for over 7 months after a hurricane. They were paying out of their own pocket for a place to live, all while waiting for the insurance company they'd paid for years to step up and help.
Okay, so what's being done about all this? California is trying this massive regulatory overhaul. They're calling it a historic deal. But the outcome is anything but certain, and the solution itself is pretty controversial.
The plan is basically a trade. The state will let insurers use these new, forward-looking computer models to predict future disasters and set their rates. In exchange, the companies have to promise to actually write more policies in high-risk areas. The hope is to lure them back, but a lot of people are really worried about this.
And here's why. This is the core of the problem. These new computer models, they're essentially black boxes. Nobody outside the insurance company gets to see the data or the assumptions they're using to come up with your premium. It's all done in secret. So the big fear is, are we just trading transparency for availability at a much, much higher price?
And that's really the critical question on the table. Regulators say they're getting a firm commitment from insurers to come back and cover people again. But critics are worried that they're basically just handing these companies a blank check with very little oversight. Ultimately, this whole mess forces us to ask a really tough question about the industry. The entire system is built on a promise of protection, but it's fueled by this relentless bottom-line drive for profit. And when those two things collide, it seems like it's always the person paying the premiums who gets hurt.